Hey everyone, welcome back to Corporate Decoder. In this video, we're diving into FirstEnergy's latest financial filing. Let's just say there's enough here to keep the lights on and maybe cause a few sparks of controversy along the way. We'll tell you everything you need to know in simple terms. FirstEnergy, if you don't know, is a giant power company that serves millions of customers in the Midwest and Mid-Atlantic from Ohio to New Jersey. This report is for the first 3 months of 2025, a period ending in March. This is called their 10Q filing, basically a quarterly checkup on the company's financial health. First, let's talk about the money. FirstEnergy brought in $3.765 billion in revenue, a notable jump from the $327 billion they made during the same period last year. That's like adding an extra $400 million to their bank account. A lot of that came from their distribution and retail arms, where revenue jumped by almost $400 million. Transmission, which is moving the electricity around, also saw an increase of about $70 million. Okay, so revenue is up, but what about expenses? Operating expenses also climbed, hitting $3.111 billion, an increase of about $339 million this year. Looks like someone was burning the midnight oil or coal. Digging deeper, interest expenses actually went down a bit from $305 million to $288 million. All this shakes out to earnings per share. Basic earnings per share increased from $0.44 last year to $0.62 cents. That means more profit for each share of the company's stock that investors own. Now let's peek at FirstEnergy's balance sheet, which is like a snapshot of what they own and owe. Their cash and cash equivalents, think of it as readily available money, stands at $132 million, up a bit from $111 million at the bit from $100 millions at the end of last year. Their biggest asset is still their property, plant and equipment, mostly all the power lines and transformers and other things they use to keep the juice flowing. That's worth over $41 billion. On the other side, their long-term debt sits at a hefty $21.2 billion, a decrease from last year's $22.496 billion. Total common stockholders' equity, which is like the owner's stake in the company, is $12.5267 billion. Now, let's examine the cash flow statement, which gives you an idea of where money is moving in and out of the company. The net cash from operating activities tells us how much cash a company generates from its normal business operations. It went from negative $40 million to positive $640 million. That's quite a turnaround. But it's not all sunshine and rainbows. The amount of cash spent on capital investments like upgrading their power grid and other equipment increased from about $790 million to over $1 billion. They also ended up taking on new debt and issuing new equity compared to the previous period. All those payments make a big difference to the bottom line. Their weighted average number of diluted shares outstanding also increased during the quarter to 578 million. So you should expect the basic EPS to decrease in coming months as a result of the dilution. Now let's move on to Jersey Central Power and Light, JCP&L for short. It is a wholly owned subsidiary of FirstEnergy. They are a major player in New Jersey. Revenue for JCP&L for this quarter was $566 million compared to $466 million for the same quarter last year, with net income of $49 million compared to a loss of $8 million last year. Operating expenses also decreased overall from $462 million to $492 million this year. The biggest expense for JCP&L is purchase power, which is electricity that they buy from other power generators to distribute to their customers. Assets for JCP&L totaled around $10 billion, roughly $7 billion of which is their plants and equipment. On the liability side, they hold about $1.7 billion in long-term debt. Ultimately, the bottom line is that JCP&L moved from a loss of $8 million to a net income of $49 million. Very impressive. Now, let's look at some of the potential challenges these companies face. These are listed as forward-looking statements, which are, as the report defines them, based on information currently available and are subject to certain risks and uncertainties. One risk, as you can imagine, given their past, is the potential liabilities from government investigations, especially those tied to HB6. They also acknowledge they could face issues if they don't comply with that deferred prosecution agreement. Economic conditions, inflation, interest rates, supply chain disruptions. Any of these could throw a wrench in the works for FirstEnergy and its customers. Then there's Mother Nature. Severe weather and the increasing potential and actual severe weather is a constant threat to power companies that may increase costs of restoration or worse. Legislation and regulations also always has a big impact on this industry. The laws around things like rates, cybersecurity, and climate change, all of it can change the game. And speaking of ratings, FirstEnergy is at the mercy of credit rating agencies who could downgrade their debt, making it more expensive to borrow money and impacting the bottom line. One that a lot of people face right now is the human capital management. These include finding and keeping skilled workers to replace the experienced ones. Finally, there is a significant part regarding climate change. The company needs to meet publicly disclosed goals relating to opportunities, improvements, and efficiencies, including FirstEnergy's GHG reduction goals, while at the same time being subject to changes in federal and state rules related to climate change. Let's wrap up by highlighting FirstEnergy's key investments. Notable ones include equity investments over which the registrants have the ability to exercise significant influence, global holding, which FEV has 33.3% equity ownership, and Value Link Valley Link is expected to be accounted for under equity method accounting. There are also key commitments, guarantees and contingencies from the registrants, which you may want to check out for further reading, and of course all the relevant documentation and exhibits. So what's the real story here? On the JCP&L side, things look good, making a return to the black. But on the FirstEnergy level, while profits are up, keep a close eye on the company's ability to deal with those government investigations, the ever-changing regulatory landscape, the upcoming operational expenses, and severe weather. While they're hitting earnings goals for now, some clouds are on the horizon, especially related to what regulations and the courts end up doing with them. They are clearly focused on increasing shareholder value, and that's good, but it remains an uncertain landscape. A company like FirstEnergy, with such a major reach across the American heartland, has responsibilities to investors, to customers, and to a future powered by responsible decisions. Thanks for watching, and please subscribe, like, and comment below if you enjoyed the video.